Hi everyone, welcome to Fundraising 101, where I'm going to hopefully teach you how to raise venture funding like a pro. So, let's get started. $200 million. I've helped raise over $200 million both personally and advising software companies. So, I think I have a little bit of expertise to be able to share with new founders, more mature startups, wherever you might be in that maturity cycle. So today we're going to talk about getting started. This is part one of what's likely going to be six-ish. Still working through the details on this, but today we're going to be talking about getting started, fundraising basics, key principles, preparation, organization, and timelines. And to look ahead a little bit, the next one will be about creating a competitive process, finalizing your materials, going to market, term sheet negotiations, and then ultimately closing the round, hopefully. Today, I'm going to talk a bit about my background, what my goals are for this course, fundraising basics, who, what, where, why, when, getting prepared, which is the key takeaway from today. If you're thinking about fundraising anytime in the near-ish future, what are the steps you can take to make sure you're maximizing your potential outcome? And then lastly, key principles to think about when you're going to go and fundraise. Background, a little bit about me. Why are you listening to me? So I've been in B2B SaaS in tech for about 13 years. I've overseen teams across go-to-market, CS, ops, and people. I've done basically anything you can do at software companies. I've built teams across the globe. I've managed teams of over 80. I've hired many, many hundreds of people, and I've also fired fewer hundreds of people. I've been in roles in companies where we were bootstrapped and profitable, as well as companies that were venture-backed, obviously. And I've just seen this full spectrum of startup land. I've gone from 2 people to 100, 10 to 350. So I've led companies from inception through rapid growth phases, acquisitions, downturns, pandemics, wars, and literally everything between. So I've seen a bit of it all. Back to fundraising, I've personally raised about $200 million with my CEO at my last company, People AI, and then I've helped to advise a lot of other startups, 2 here listed, Acquire and Blue Pallet, in their fundraising cycles. And I've helped everything from closing a $100 million round to a $100,000 seed check. So seen the full spectrum. I've also interacted and closed rounds from some of the best VCs on the planet. If you're thinking about fundraising and none of these names are recognizable to you, I would strongly consider doing some research before you get started. Andreessen Horowitz, Iconic, Lightspeed, GGV, Acadian, Index, Mubadala are just some of the best of the best. So at a minimum, hopefully you recognize some of these names. My goals for this course: shift the power dynamic from the VCs to the founders. And what do I mean by that? How can we shift the power dynamic? First, VCs see hundreds of deals a year. They'll see thousands over the course of their career. They might only do a few a year, but they still get looks at so many, and their peers are VCs and their friends are VCs, so they just have a ton of information on you. A world-class founder might do 3 to 5 raises ever. So, obviously with that, VCs have a tremendous amount of information that they can control the process and the power dynamic, putting the founder at a disadvantage throughout this whole process. And then in addition to that, what I see that bothers me the most is VCs are the ones that produce most of the content about fundraising, which is insane. It's the fox guarding the hen house type situation when it comes to founders trying to learn what actually happens in a fundraising process. So how do we shift this? We need to arm founders with real strategy, real tactics, and real tools. Founders need every advantage they can, given that VC see 100, you might see 1. You need every advantage you can get to control the power dynamic. And when I say power dynamic, I mean owning the timelines, which we'll talk about today, the participants, the information. If you can do that appropriately, you can create a competitive process and ultimately deal heat around your fundraise, which is the entire goal. This whole power dynamic about participants, timelines, and information will continually come out throughout all of these courses, so keep that in mind. Before we get started, let's set some expectations. If you're going to be spending a lot of time with me talking about a topic that I think is super important. I want to make sure you know what you're going to get out of it. This is going to be my honest experience. I can only talk about what I've seen and done, not something that might be super specific or niche to your industry or your specific size and situation. These are going to be real battle-tested tactics. I'm not going to be making stuff up. This is only stuff that I have personally done and seen. Strategies to give you an edge. Applicable insights for seed through growth. As mentioned, I've closed $100 million rounds. I've closed 100K seed rounds. So no matter what size, if this is your first fundraise or maybe you're at Series B, C, D, and you're looking to pick up some new tricks and tactics, this course will be great for you. And lastly, this is going to be a lot. It's 6-ish long-form content pieces. And the reason for that is this is life or death for your company if you choose to raise venture capital. And I take that super seriously. Fundraising actually isn't my bag. It's not really what I'm most interested in. I'm more of an ops, strategy, grinder, startup character. But fundraising is a critical component to, a venture-backed startup success. So in my effort to help founders, this is something I think that needs to be talked about more. These strategies will work no matter what's going on in the market. If the market is amazing, if it's down, if it's upside down, whatever. These are best practices that will help you close a round. Let's talk about the other side, what this is not. If you're looking for how to pitch your startup, term sheet bingo, slide deck templates, legal advice, finance 101, if you're looking for a hack, a trick, or a shortcut, it's going to be none of these things. Most of these can be found from VCs themselves about how to do the best deck or whatever metrics they're looking for. So go find that somewhere else. And it's definitely not a shortcut. This is what I'm going to be highlighting over 6-ish courses is actually a lot more work to make you look professional and be prepared to help create a competitive process. So it's definitely not a guarantee. You can take this in course and watch it 100 times over. I can't guarantee you're going to close around. Fundraising is wildly complex and unique, dependent on all kinds of factors about your business. And it's not going to answer every single question there is. There's just too many nuances within fundraising. And it's definitely not a Band-Aid. I really want to touch on this point. If you can't raise because your business sucks, good luck. I'm not going to be able to help you. You're not going to be able to create the dynamics necessary to close a round from a great VC if your business is just stuck in the mud. None of this advice mitigates the need for a strong business. You should only be raising venture capital if you have a great business. So this doesn't mitigate any of that. You should be looking at things about business 101, not fundraising 101. If you don't have a great business, team, product, or market. Lastly, this isn't the only way. There's tons of ways to raise. I've literally seen people close deals on napkin pitches. You spent 8 years at Google and then went to OpenAI and then you start a new company and, you got term sheets landing. That's great for those types of people. This is for more of the, great businesses, great entrepreneurs who maybe haven't had their first billion-dollar win yet. So, one last point from my sanity. No, I will not introduce you to VCs. Please don't ask me. It's not my game. Not what I'm interested in doing. I probably don't want to invest in your startup. Again, I'm going to tell you how to get into these cycles with these VCs of your choosing, but I will not introduce you to them. I'm giving you all the information. Please don't ask me to do that for you. Okay, sorry, real quick. There's a lot of talking. Consider this. Before we get started, a quick thought experiment to hopefully help reframe the way you're thinking about fundraising. One of the biggest issues I see. Consider what it would take to close a $10 million sales deal. Imagine you're, a founder or a sales professional that's trying to close a $10 million sales deal at Verizon. What would go into that? Turns out It's very complex. First off, you'd take a long time horizon to get it done. You'd have a world-class team assigned to it. You'd be doing incredible amounts of research, mapping the orgs, laser focusing on who you want to sell to. You'd be highlighting the buying committees and the decision processes. You'd be building relationships, texting your champions. You'd be identifying the budgets, doing all kinds of stuff. Again, forecasting the deal. You'd be nailing pitches, presentations, custom demonstrations, mastering objections, deploying tons of mitigation strategies, tons of cycles on legal terms and pricing, legal reviews and contract reviews, never-ending follow-up and communication. You'd be creating compelling events. And you'd be having dozens, more likely hundreds, if not thousands of meetings to close this deal. So, why do founders who are looking for a $10 million investment in their software company walk around Silicon Valley with 25 slides and an open hand? It makes no sense. It's not strategic, it's not thoughtful, it's not going to work. So, let's fix that. Let's think about these things in a more strategic nature. Jumping into fundraising basics. If you've already raised around, you probably know some of these things. Here's some of the key issues I see when I talk to new founders about fundraising. What is venture funding? Venture capital is pooled investments deployed by VCs who seek private equity in startups with high growth potential. These are generally highly risky, high reward opportunities. Something really to understand if you don't know this already or understand, there's tons of different types of VCs for different stages, sizes, all kinds of fun stuff. I'm going to run through some of them quickly. You've got your angels. These are usually individual investors, high net worth experts, or former founders. Seed investors. These are people who provide capital in the early stages, usually used to get you from like kind of that initial idea or initial traction to kind of real customers and real revenue. Early stage. Consider these Series A through Series B investors. These are people who provide capital during the early stages of growth. Usually you have some sort of product developed. You have a market strategy. Mid-stage, I would define this from Series B to Series D-ish. These things are blurry, by the way. That you already have established revenues, customer base, and experiencing rapid growth. It's really time to go. Growth investors, this is Series D+. These are people that are investing in large-scale revenue-generating, hopefully maybe profitable companies. And then crossover investors. These are people that are investing in startups as they're considering going public. So you get their investment at a private level, and then they essentially guarantee that they'll invest when you list and go public. Lastly, strategic investors. These are like, Salesforce, Google Ventures, Accenture, Shopify. They have VC arms that usually invest in companies that are developing in their ecosystem. So something to consider. And there's tons of other stuff. There's accelerators, private equity, hedge funds, family offices, syndicates, sovereign wealth funds. There's all kinds of players in this space. And there's also a lot of gray area. Markets change quick. Funds and focus changes frequently. And so someone that might, yesterday been a seed investor might be a Series B investor and vice versa. Things can change quickly. So in the next course, I'm going to talk about how to qualify firms and making sure you're talking to the right firms, because their focus can change so frequently. And if you're talking to someone about an early stage investment, but they only do growth stage investments, they'll take that meeting, but they'll just waste your time. So I'll talk about that in the next course. Really important, why you shouldn't raise. Most businesses shouldn't raise venture funding. They're not venture fundable. It's more likely to kill your company than to help it. I don't know if you can see this. If you don't raise, you have more control, flexibility, and simpler exit strategies. So if you want to sell your company after you've raised a lot of money at a certain valuation that's under your last valuation, the chances of you actually making money are super low. The ways to get screwed are unlimited in terms of preference stacks and everything in between. And lastly, are you able to achieve a multi-decabillion outcome? If not, you shouldn't raise venture funding. Here's an interesting tweet from Jason Lemkin. If you don't follow him, he's a great follow about the dynamics in the venture and tech world. But basically, he highlights here the amount of exits a VC fund needs to get for the amount of money raised highlights how they need tremendous outcomes for the capital raised. And that goes on to you, the founder. Getting funded is not winning. You've only committed yourself to an exponential outcome that you are married to, and it's more likely to be 10 years of slow company death than you're going to be in the Facebook movie Part-2. If you don't have to do it, don't. My first company, we bootstrapped, we were profitable, ended up being an acquisition, great for everybody involved. We were our own bosses, we were able to do whatever we wanted to do. It was amazing. So I would suggest doing both, that if you don't have to, don't do it. Why you should raise. You experience rapid growth. You have tremendous repeatability already boiled down. You're just pouring gas on the fire. Putting in $1 equals $2 on the other side. You have deep tech or required large upfront investments. So say you need to do some intense engineering. You need the world's best engineers to build this thing that's pretty wild. You might need venture capital. You're trying to grab as much market as possible. You've got a wide open field ahead of you. You know how to get it through your already experienced rapid growth and repeatability. It's a TAM grab. Potentially there's opportunities for acquisitions that you want to raise capital for. And lastly, I think there's one more, but you're trying to build a friggin' war chest. You want to have a cushion behind your aggressive TAM acquisition to be able to scale and take interesting bets. Who should you raise from? If you're going to raise at all, raise from the best, obviously. If you're going to go to school, try to go to the best school. If you're going to play anything, try to be the best. Always try to get the best firm possible. And I'll tell you why it benefits you. It's a fantastic signal that great firm has great brand value when it comes to closing employees or hiring employees, closing customers. There's a low risk of them backing out. They have support systems and structures in place to add value. They have large balance sheets to be able to continue to invest in your company. And it simplifies future raises. If you say you've got a tier 1 VC on your cap table like Andreessen Horowitz, you're going to get VCs coming inbound to you afterwards saying, hey, how can we invest? Can we follow on? I'm interested in what you're doing, because it's such a strong signal to get one of the world's best VCs invested in your company. And most importantly, you'd be shocked how much this happens. Their check clears. If you're going with some third-rate, unknown, flash-in-the-pan VC, angel person, whomever, literally their check might not clear after you close the round. So that's something that can kill your company, be devastating. So again, if you're going to raise from the best. When should you raise? 3 words. I'm going to come back to this in a minute. Cash out date. I'm going to come back to this. Okay, getting prepared. Let's get into the meat of what we're talking about today. So a successful fundraiser, as already mentioned, is competitive. Without deal heat, creating a compelling event, creating a compelling event is difficult. Without a compelling event, getting a VC to commit is very challenging. And without commitment, filling the round becomes nearly impossible. And with that, forget favorable terms, great valuation, whatever you were looking for, or even closing the round. It's just not going to happen if you can't get deal heat, compelling event, and commitment. No deal heat, no leverage, you're not getting it done. So how do we create a compelling, competitive fundraise process? First, get fucking organized, people. Okay? So how do we get organized? First, the timeline. Set a calendar on your timeline and work backwards. Let me move my face to see if this helps. Work backwards from your timeline. Okay, so what should be included in your timeline? Cash out date. Your financial forecast. Are you going to have a great Q2 and a shitty Q3? You might want to close the round in Q2. business linearity? Are there ebbs and flows to your business? Is there seasonality, things you need to bake in? Is there holidays upcoming you need to think about? Macro market dynamics you need to consider. Interest rates are changing. There's a presidential election, competitors raising. All of these things can impact your fundraise. And so if you're not aware of them and baking them into your process, you might get caught in a situation where the market changes below your feet and you weren't prepared for it. Controlling the timeline is the single most important power dynamic in the entire process. And I'm going to talk more about that throughout the course, but put that in your mind right now. A great fundraise process is 3 to 6 months of perfectly executed timed actions, culminating in a competitive cycle. So what's kind of in there? Here's a preview of 15-ish high-level things, all of which I'm going to go into super detail about. But this is the type of stuff you need to get done in a compelling, competitive way to be able to get a term sheet of your valuation of your cash with your VC done. Cash out date. Let's talk about that again. Give yourself as much breathing room as possible. I talk to startups sometimes and their cash out date is in throwing distance and they're stressed. It's a horrible position to be in. Of course, you cannot have leverage if they can see your death date looming and coming. Again, 3 to 6 months to run a good process. You need at least 2 to 4 quarters of runway before you go to raise. It's always best if you don't need it. Say, hey, I got a year of runway, whatever it might be. If they can see your death, even if they love your company, a VC will just wait. Hey, you're going to be cash out in November, you're raising in July, whatever it is. They'll wait till September, October to close the deal, because then you'll be really desperate and you'll give them terms that are extremely favorable to them. So yeah, cash out date is one of the most important things to keep in mind. Keeping your company alive is one of the most important things. Okay, a calendar, setting a calendar with these events in mind, and then setting up a multi-tracked work process. I'm going to share this calendar as well with everybody. You can copy it, and then once you copy it, you can add your business operating, milestones. And then obviously from the start date. So this is assuming you started in January 1st. Everything you would do over the course of 14, 15 weeks to get to a cash close position. This is not guaranteed, obviously, and I will go into full detail about every single one of these steps throughout my course. But if you're going to do nothing else but take this and try to make a run for it, do it. You'll be better off than most startup founders that I talk to. So let's jump back into it. Okay, so now that you're going to be armed with that calendar, again, I want to reiterate, controlling the timeline is the most important power dynamic. If a VC controls the timeline, they can wait until it's convenient for them to give you the capital, which probably means bad dynamics for you in terms of the term sheet, as well as not getting multiple term sheets to be able to leverage them up. So controlling the timeline, getting back to work, most importantly, is the most important power dynamic. And I will reiterate this constantly, but we'll come back to this in more detail. Again, back to getting organized. The team. Most founders I talk to, even if they have 50 employees, 100 employees, whatever it might be, a lot of founders just go out and do this alone. And I would advise don't do that. Get at least one partner in crime. Who that is within your organization may change. It might be your finance person, your ops person. You might have a chief of staff. It might be your EA. It could be like literally anybody, but get somebody in there to help you. There's so many details, so many meetings, so many notes, so many players, so many names. It's a massive distraction. You also have a company to run to make sure you're being successful over this 3 to 6 months, or else you're not going to be able to fundraise, obviously. It can be really detrimental to your business. And then obviously getting someone to help keep the trains moving, setting the next steps, keeping you up to date on what this partner said, or where finance is at, or where legal's at. Keeping things moving is so critical to keeping control of the timeline. And then lastly, being able to delegate stuff, project manage stuff will be huge. Someone you can really trust to run with, finishing the deck or filling out, completing the data room, whatever it might be. This is huge. Lastly, I get asked this a lot, tooling. A successful fundraise has thousands of actions and hundreds of moving parts. You need some tools to be able to track this stuff and manage the process, but don't overthink it. If you're at seed stage or Series A, use Google and like DocSend or like something like DocSend where you can share a data room. If you've got some cash already and you can invest a little bit more and maybe things are a bit more complex, the ideal stack is like Google, DocSend, a CRM. It doesn't matter what CRM. You don't even need the CRM, to be honest, in like Box or some kind of version control. So Google will be sheets and slides, so you can track notes, dates, calendars, round composition, deck. DocSend is for a data room for sharing, and then in DocSend, when somebody opens your data room or clicks a document or does whatever, you can see it, which is super valuable. Box, when you and your team are editing stuff that's in the data room, maybe it's legal, it's outside counsel, it's whatever. It's great to have a place for version control. And then CRM, again, it doesn't matter what CRM you use. It could be Salesforce, HubSpot, whatever else is out there. But you can track your firms in your CRM, gather the information about them, which will change over time, which I'll talk about in my next course, tag and label them to not be contacted by marketing, obviously, and that'll become like your source of truth for the market. My last thing I would advise is don't buy any of these all-in-one fundraising tool crap. I've never seen one that works, and I'd advise you not to spend any money. DocSend is really cheap for like the lowest level, and most of these other tools I've seen don't work. So don't get cute with it. Don't overthink it. Lastly, this is going to be probably, honestly, the most important part about getting prepared. Networking. Network. If you have zero network, you are starting so far behind. It's going to be difficult to overcome this. You got to be a network lunatic. Events, mixers, build a presence on social media, join an accelerator, which I'll talk about next time. YC, any of these things to start getting you into, the venture funding community lens, being around other founders, peer groups, CEO meetups, advisors, consultants. There's so many ways to network. Just cold emailing people, cold DMing people, whatever it might be, you've got to do it. You can't do it without a network. Once you get a network jump. Hey, I met with you. Who's the most interesting founder you know? Hey, I'm trying to raise a Series A. I saw you raised one recently. Can I talk to you? Which most founders are happy to help if you ask in a professional and useful way. Then say, who else do you know that raised a Series A recently? Network jump, add value, and then don't stop. I'm going to get into the next section about how, or next course about, identifying the universe, finding the VCs, getting introduced to them, and or cold emailing them. A warm intro is always best, obviously. So that comes through your network. Okay, before we end today, key principles. So what are the design principles for a successful fundraise outside of the power dynamic, which I've already discussed? Things to keep in mind as you're going out there and going to market. Number one, VCs are not your friend. They're a necessary business tool to be able to grow your startup. They look at you as a tool to grow their investment, get good returns for their LPs, and they can make money. You view them as fuel to launch and scale your business. They're not your friend, no matter how many cool things they invite you to or high fives they give you or whatever's going on. The amount of times I've seen them turn around and screw over founders is almost unlimited. So they're not your friend. Remember that. 2, this blows people's minds for some reason. VCs are looking for reasons not to invest. They're not looking for reasons to invest. You might have the best meeting ever with them. They love you. You've met with them 10 times. They're obsessed with your business. They'll find one little hair in the soup that might be totally benign, and they'll say, hey, we can't do it because of that reason over there. They'll look for one no out of 99 yeses and say no. So we'll talk later about how to reduce the surface area of no's. But again, they're looking for reasons not to invest. You got to have perfect execution across all of this broad spectrum of input and data. Deal heat and competition win. And this entire course is going to be about how to create deal heat competition. But that's the only way. It is the only way to get a competitive term sheet from the best founder at your preferred valuation, is deal heat and competition. And lastly, I've already touched on this, control the power dynamics at all costs. Information, participants, timeline. These things need to be tightly scrutinized and understood as you're going to market throughout your process, or a VC will blow your timeline up because they have better information than you do, right? So things to keep in mind as you're going. Next up, let's take a little bit of a look ahead. I don't know if this is what you wanted to get out today, but I had to set some context before we get into all the other sections. The next course, I'll be talking about identifying the right firm and partner, getting meetings, qualifying VCs, setting up these parallel work tracks I've already touched about, a tiered approach, tiered looping, how to think about your target valuation, what cash you need, as well as getting more into what materials you might need to, again, look professional. You don't want to get out there and start fundraising and someone asks you for a document. You're like, okay, I need 2 weeks to build that document. Your deal will die. It'll be a terrible look. So this is coming. And then at the top, I showed you kind of all the other things I'm working on. Last takeaway, remember, a $10 million investment, a $500,000 investment, whatever it is, it's a sales deal. Think about it in that same lens, and you will be infinitely more well-equipped to go and close a $100,000 investment, a $10 million investment, a $100 million investment. It is a sales process, so just remember that. Cool. All right, well, thanks, everyone. If you followed along, this is like 31 minutes. Again, this is going to be like hours and hours and hours. Of course, I'd appreciate a like, a follow, a comment, whatever. Again, I'm doing this all for free. This isn't really my bag, so any boost is super appreciated. You can find me on Twitter at @TheCoos, LinkedIn, or YouTube. I'll be uploading these to YouTube as well. And just, if you have any other questions, feel free to shoot me a note. If you followed along, you're already on a better track to raising a great round, and looking forward to hearing about it. Thanks.